Thanks again, Russell and Bowen, for joining us for our East Private investment update today. We've had a few changes at East Private over the last few months. We've undertaken a merge with a group called Catapult Wealth. So there's information that go out to clients around that. As for our models we run, nothing's changing there. We still continue to run the models with enhanced asset management for the management of some clients' money. So just today's video, we really just wanted to get an update from Russell on the December report we sent out. I know it's February, but there's been a lot that's happened since then. So probably just to start, Russell, the report we sent out in December. Can you just give us a very broad overview of that, but more importantly, what you're seeing at the moment with the recent volatility?
Yeah, sure, Jeremy. So just to recap on the report, there was a few key themes and fundamentals that we touched on. I know it was a little bit technical versus some that we've done recently, but I think it's important to get a message across of what we're seeing in the markets at the moment. Longer term performance we're very happy with. When we set up these portfolios, it was a 2-year process to really do a serious amount of research and work on the structure and the process and how we implement that going forward in order to deliver good long-term results. And longer term, we are matching our benchmarks, and so few people do. We touched on that a little bit in the report, where if we were trying to build a portfolio of international managers and Australian managers over 10 to 15 years, what that potentially could look like, and using the SPIVA results, the Standard & Poor's results, who go through all the managers from Australia who target international shares. 95% of them fail over the long term. So it's very hard to set up a portfolio with a manager today and expect to, let alone match the benchmark, but beat the benchmark over time. And in Australia, the numbers aren't that much better. It's about 85% of managers outperform. So there is a little bit of ability to outperform in the Aussie market, but it's still very, very small. So the process that we've adopted and the thematic that we've adopted is working very well. So we're very happy with that. And it's been incredibly stress tested over the last couple of years with COVID, everything that's happened in the financial markets, what's been thrown at them. So very, very pleased, very, very pleased. The only real hiccup, and well, not even really a hiccup, but the slight reason for the underperformance against some key benchmarks at the moment are mainly our underweighting to property. And what we're seeing in property at the moment is I think, not sustainable.
No, in the last month we've seen a bit of movement there as well.
Yeah.
So I'm sure you touch on that.
Yeah, we'll come back to that in a second. So, just to give you one example, half-year reporting season is out at the moment, so that's when companies release a lot of their reports and gives us a good insight to what they're seeing. There's a dairy farm over on New South Wales, dairy farms, and some of your clients are obviously dairy farmers, and they're claiming property revaluations of 23 to 24% over the last 7 months. I mean, that's just not normal.
No.
That's not normal. So it just feels like we're kind of at the tail end of these interest rate falls. These valuations are now starting to come through, but what we're going to see now is a bit more pressure on valuations right across the asset spectrum.
And you're seeing that with bank lending criteria as well. Banks being quite hesitant to lend, and their valuations are coming out pretty low as well. So we're seeing a lot of residential lending for clients as well, and particularly in the commercial space, we're seeing that too.
Yeah. I mean, the big ticket item at the moment, which we also touched on, was inflation. Yep. Inflation in the US at the moment, we just hit 7.5% for the January update. That's huge. We haven't seen that in a generation. No. So I wasn't even born last time inflation rates were this high. Yeah. It's quite interesting to see what's happened. So when we've had a very accommodative monetary and fiscal policy period, where a lot has been thrown at financial assets and markets in order to get through the COVID hump with market shutdowns and economic shutdowns, and people just not being able to work. So there's been a lot of monetary and a lot of money being thrown at those people. Early access to super as well. That's the first time in history that's ever happened. But all that is now coming back. So as we work our way through COVID and the government tries to find a more sustainable path forward, I think we're at that point now and we're certainly starting to see that, where the fiscal conditions are going to move to a bit more of a tightening bias, so they're not going to be as lax. And then we're certainly seeing that in the bond yield, for example. The 10-year bond yields around the world have gone from 60, 70 basis points to close to 200 basis points, or 2% at the moment, and they look like they're going to go even further. So what that does is it impacts on valuations. So the higher the bond yield, or the risk-free rate, which you put into discounted cash flow models and whatnot, the lower the valuation stream for that series of cash flows. And that's what we're seeing at the moment. So we're seeing a bit more of a garden variety market correction, which is something we haven't seen for two and a half years since COVID. So I think this is pretty healthy for the market. Typically we get one or two of them a year, and we're certainly going through one of them.
So when you refer to it as a garden, I've never heard that term before, Russell. That's interesting, the garden variety of corrections. What's your outlook for length? Is there more to come? Are we heading back to normal? What's your thoughts on where we're heading with this recent movement?
I think there's probably a bit more to come. You don't have generational high inflation rates. We need some sort of response from the Fed, and the expectations or estimates from economists are so broad at the moment. If they can't get it right, me sitting here, it's probably impossible to get it right. Which is why we use the expertise of a big investment group like Vanguard. They've got 40 to 50 investment specialists globally sitting around debating this, arguing, managing the asset allocation to the portfolios and getting that right. I mean, it's a real strength to have behind what we do. But me personally, I think interest rates are going to go higher, and asset valuation is going to fall. Market usually goes first, so the stock market being the most fluid, the most liquid, the most dynamic, always falls first. And then you see that filter through unlisted assets like properties, infrastructure assets, all that sort of stuff. So I think that's to come. Next sort of 3 to 6 months, we'll start to see a bit of easing in valuations on that part of the market.
And which means more volatility for client portfolios as the market works in.
Absolutely. But that's the stock market. Short term, it's a voting machine, and there's a lot of volatility. Longer term, if you stick in the market, it's shown over time to only go one way, and that's because of long-term monetary policy, and the bank's constantly feeding that inflation machine.
Okay. We always start these videos with the intention to keep it to a short 5 minutes, but we like talking. So just on that, so in terms of opportunity, so Bowen, you've been doing a lot of work on the individual stock selection side of things, and as we've said in recent videos and recent reports, there's not been a lot that we've added to portfolios, probably because of the way the market's been, and a lot of it doesn't make sense in terms of normal models and so on. But with reporting season underway, Russell, you're halfway through it, busy going through lots of reports.
Just to touch on that, it's probably a good thing that we haven't put a lot of stocks into portfolios. So if I look at the universe that we sort of track around 80 odd companies, now the median fall in technology, for example, over the last, from their recent highs, is about 30 or 40%. Now that's not a small...
Aussie and international.
No, this is just Aussie. I think it's probably worse than the NASDAQ if you look under the big indexes. The falls have been huge. And the average fall across, we've covered about 8 or 9 different sectors, is around 20%. So if we had been a bit more active more recently, that would have been to the detriment of the portfolios. But the indexes are held up pretty well. Underneath that, it's been, for a bit, loss of a better word, it's been carnage.
Because we have these conversations constantly, I guess, Bowen, and you've got your filters we work through and we run through, and you do your models, and you've come to the investment committee a number of times. So these look great, but then we look at the environment and we haven't participated in them. So give us some ideas of companies you've been looking at that still look like great companies, but have obviously been affected by the recent market movement and potential inflation.
Absolutely. So, a lot of the tech companies that we do cover, we've spoken about today, that have just been absolutely smashed. You've got your next DCs, even EML, for example, which is in the portfolios, has copped a bit of a pullback, due to all these rising interest rates and inflation pressures. And the technology stocks sector in particular has been hit very hard. And it makes it extremely difficult to look at a new company and judge whether this is going to be something that can outperform the index over the next 6 to 12 months and is going to add value to a client's portfolio. So with this volatility, as Russell said, it's been extremely beneficial for us to just sit and just, we've got all our valuations, we've built up a lot of knowledge on a lot of companies, and we're just sort of watching things play out. We're seeing that at the moment, being in the index is a safer position to be in, and it's getting better returns for a lot of client portfolios. So,
Are you seeing more opportunity with market pullbacks recently? Or?
It's coming back towards that point where valuations make a little bit more sense, especially for some of those tech guys like NextDC, for example, that's running at almost an operating loss, but the growth is just so astronomical that it's valued on a future cash flow sort of thing anyway. But we're seeing those valuations get pulled back closer to a lot more like a stable position where we see, positions maybe coming into fruition soon.
Yeah.
And I think this reporting season will hopefully flesh out a few opportunities. But as we said, index position's been a really strong position to be in, and we're not just going to jump at opportunities just because things potentially look okay. We want to be confident that this position is going to outperform the market.
Yeah. And the longer I do this job for, I'm planning for 15 plus years, and I think planners traditionally relied on broker research, so Morningstars and Lonsec and all your big broking houses, and it's a case of them saying it's a buy or it's a sell. There's far more to the process than that, and I appreciate the work you guys do and the resource we've got in terms of the information behind it. There's a lot of companies that you're very familiar with, just waiting for the right time to jump in and grab them. So, which will work for while we're getting index returns, clients are making money, but there's an opportunity there to add value at the right price.
time.
So that's the strategy we've implemented.
And typically, volatility and market corrections are a good time to look at buying some of these things.
Yeah.
Lower the price you pay, the higher return. It's pretty simple, but maybe not simple in practice. So having a strategy that I've implemented for 20 years in financial markets, having a good line of sight through all this volatility, knowing what we're looking for good companies with good growth, and their prospects remain solid, irrespective of what's been thrown out in the future. That's what we're looking for, and that's what we're looking at. So all within there, there's a good price to be able to buy them. So we're just waiting for those opportunities to come. And hopefully this correction continues for a bit longer, and we can pick them up, and then in 2-3 years' time, this will be a forgotten memory. Performance. Hopefully we've got it for performance.
Yeah. And just broadly, Russell, you do a lot of work outside of the models you run for enhanced asset management and these private, but and obviously look at a lot of small caps that aren't within the realm of our approved list and what we play in. But through your reporting seasons, you've got years of models that you've built, and companies, sectors. What sectors are you seeing attractive at the moment through the most recent reporting season? What's performing well? What's underperformed? Is it retail? Is it mining? Is it?
Yeah, well,
where's your
reporting season's really only just kicked off, so there's probably, I would say, 20 or 30 companies that are reported. We look at about 500, so we'll go through 500 reports, so we're only going to 20 or 30. Right. Key theme at the moment I'm seeing is revenue growth is still pretty good, so companies are being able to pass on this inflation. Costs are up significantly, so there's no
expectation wages are that up as well.
Well, wages, for a lot of the tech guys, and in particular, there's been quite a few of those that have reported out of that 20 or 30 basket. Wage growth is huge. So the RBA was looking at that as a key item to start raising interest rates in Australia. I don't know what they're waiting for, because I'm seeing the data 3 months after fiscal close, and they should have that data already. So that's really interesting. I mean, obviously the tech sector by far has been hit the most with the long end of the bond yield going up. All sectors have been hit. So there's a big rotation out of sort of growth assets into more value-orientated assets. So resources have done well, banks have done well, and that's why the index is holding up very well in Australia, because our index is heavily weighted to those constituents. Whereas if you go in the US, it's probably more heavily weighted to tech. So I'm starting to see a little bit more reasonable value in everything else apart from resources and banks. Industrials are starting to look pretty good. So we've got financials are starting to look really good. So we've got AUB and Steadfast, for example, insurance brokers. They're starting to come back now, starting to look okay on price. Tech is looking interesting. I mean, longer term, these businesses are entrenched in our society. There's a constant shift from people buying through physical stores to wanting to buy online for the convenience, and delivery mechanisms now are such that inventory is held in your state, and so you get your delivery within a day. So there's no longer I have to wait 7 days or whatever that is. So that's just the thematic that's just going to continue for generations. So to be able to look at some of these companies today and say, well, in 10 years' time they're going to be bigger and they're going to be stronger, which is what we want in portfolios. It's an interesting time to.
Okay. Excellent. So more stocks in the portfolio potentially at good prices, I suppose.
Well, that's the goal.
That's the goal. Simple strategy, isn't it? Just get implemented. Okay.
Just got to be patient.
Excellent. So I guess for investors that we're using our models for, if you've got any questions around the, most recent report we sent out, or if you want to have a chat to Russell or Bowen on the stock side of things, just give the office a call. or send us an email. Happy to have a chat. Thanks guys for
Thank you very much.
coming in again today.
No,
Cheers.
Cheers.
Thanks,
Thanks.